Hello and welcome back, guys. In this particular session of Traveler of SPR's exam kit. Okay, so what we'll be looking at is we've been given this. Let me just pull out the other one as well. I just pull out only the first one. So basically, just to give you a summary, we've been given. Shit, man, where did the photos go? Should be in downloads. No, it's in desktop. Okay, so desktop group, right? Okay, so what we are required to prepare is that prepare a consolidated statement of financial position for traveler group for the year ended 30th November 20x1, right? So let's prepare it. Consolidated statement of financial position, right? For the year ended 31st November 20x1, 30th November 30, and then after that this O should be small. Okay, so bold it. First of all, what do? We put in the assets, right, or non-current assets. Non-current assets. First thing first, goodwill. So let's calculate goodwill. So let's see what we've been given. So in the question, okay, what do we have? Let's see. So PPE is there for Traveler, Data, and Captive. Okay, so there are two companies. Okay, so Traveler is a public limited company, operates in manufacturing. Okay, and then SOFP as at 30 November 20x1 is this. So this is already the ending figure. Okay, so investment in subsidiaries, this figure. So which could be used if the figure is not given down below for purchase consideration, right? Financial asset is also there. 108 as per IFRS 9, right? What is financial asset? It's the contractual rights to receive cash, right? So it's the contractual rights. And then after that, what could be financial assets? So it's like any receivables. In one company it will be financial asset, in other it will be financial liability, right? That's how the relationship should be. Okay, so it could be equity as well, but let's see what it is. We need to figure that out. If it's equity, then there'll be different treatment for it, so we need to look out for that as well. 108, 10, and 20. Okay, all of these have financial asset. Current assets is there. We need to look out for any PURPs. That's the most important thing over here in case of current assets, right? And any other adjustments. Your share capital, return earning, or the component of equity is given, and then non-current liabilities is also there. Current liabilities is also there. So total equity and liability is okay. So what has happened? On 1st December 20x0, that means exactly 1 year ago, Traveler acquired 60% of the equity interest of Data, a public limited company. The purchase consideration comprised cash of 600 million. Okay, so 600 million is already been given. So isn't that the same amount over here? Data. Why is it 820? Acquired further 20% interest for 220. Okay, 600 plus 220, 820. Okay, that's how the figure is there. So it's justified. So NCI at the date was 395, right? Traveler wishes to use full goodwill method. Okay, so not net proportionate method. Okay, or partial goodwill method is not there. Easy. Fair value of net assets was this much, retain earning was this much, other component of equity was there, and then share capital we can get it from SOFP. Excess value is for non-depreciable land. Okay, so let's do it. Before that, so let's see this as well. On 1st December 20x0, Traveler acquired 80% of equity interest of Captive for a consideration of 541. The consideration comprised cash of 477, and transferable land as well. Okay, so 64. So this plus this is our cost, right? So carrying amount of the land was 56 million. At the year end, this asset was still included in non-current assets of traveler, and the sales proceeds had been credited to SOPL. Okay. So what do we need to do is that basically we need to remove it from non-current assets, and then the sales proceed which had been credited to SOPL needs to be removed from there. That means debit return earning, credit non-current assets. Okay. At the date of acquisition, the identifiable net assets of captive had a fair value of 526 million. Return earning was this much, and other component of equity was this much. So excess in fair value is non-depreciable land. Good, no depreciation needed. Excess depreciation, as per IFRS 3 partial goodwill method. That means net assets method. So goodwill was impairment tested for the date additional acquisition data on this much. The recoverable amount was this much and this much. Okay, so let's prepare our COFP. So let's do both of them together. Okay, working note one. So what had happened? Group structure, yes, structure, right? Bold it, data, and then captive parent, NCI. So 60%, I think so. Isn't it 60%? 60 and then additional 20 purchase later on, right? At the end of the period. Okay, that's easy then. So end of the period means we don't need to allocate it differently for different period of the time, right? So 60%, 40% later. Later what had happened? Later what had happened? 80%, 20%, right? So in case of captive, I think it will be this figure, isn't it? 80%. Okay, so it's not further acquired, right? Nope. Best. At the year end, the NCI was only 20%, so we need to adjust for that as well. Always remember that's a bit big in this question. Nothing else is new. Calculation of net assets. And another thing while calculating this is always separate the other component of equity. So in this case, what we'll do first, let's calculate for data. Let's merge it. Okay, so add acquisition, add ACQ, add reporting. So share capital, retained earning, other component of equity, other component of equity. Value adjustment is also there, right? Adjustment, land, assets, right? So the net identifiable assets 935, 299 is retained earning 935, 299 or 229. 299 Other component of equity 26. The component of equity 26. Share capital, we can get it from here, right? So 600 and 390 for the other. Okay, so no need to worry about that right now. So what will be this figure? This figure will be this minus this minus this minus this n. Okay, so this figure will be same as this. This will have changed return earning by the year end 442 and 37. 442 and 37. 37. Okay, and then the value adjustment for land. Alright, so this will be same figure as this, and then the total will be sum of everything, right? Sum of all this, and then post acquisition will be this minus this. So same thing for active as well. So what has happened over here? Captive, right? Captive share capital is 390, 390, 169, 45, right? 169.45. 169.45, yep. And then earlier date it was 90 and 24. 90 and 24. 90 and 24, right? And then share capital was same. What about total assets? Total assets was, what was the total assets? 526. 526. Okay. So once that's done, calculation of goodwill, right? So let's calculate goodwill for both of them. Working on 3, right? So it will have to be done in different way. Calculation of goodwill. Goodwill. So cost. So there is only one cost, right, in this? Value of non-controlling interest. Cost is, how much is it? 600 million, and then after that 395. The further acquisition is not needed in, because even though we acquired extra 20%, we won't be increasing our goodwill, right? It is only computed at the date of when we acquire control. Okay, so if we had lost control, then it would have been different case, but in this case we have already have the control, right? So it's 600 and 395. 600 and 395. 395. So this plus this will be our subtotal less fair value of net assets. Always fair value, right? Net assets at acquisition, which is from working note. Number 2, this figure will be basically this figure, right? And then our total goodwill will be total goodwill. This figure, same thing for captive as well. X control V, and then in case of cost there will be two things in captive, right? So captive, there will be different thing because 80% of captive for 541 million, right? Okay, so total is 541 already given, easy. So cost of comprised 477 and non-depreciable land of 64, right? So that means cash and land. So what had happened was cash and then land, right? So how much was it? 477.64. 477.64. 64, right? So this will give us a total of this plus this 541, right? So this is how it was calculated, okay? And then after that, that figure is already there. What about fair value non-current assets? It's using partial method, isn't it? Partial goodwill method, yep. So what we will need to do is that this figure into 20%, okay? We will need to do that as well. This plus this, right? So that's the goodwill. And then less impairment. Same thing over here as well. Impairment, we don't know the impairment, so we need to find out. Goodwill had been impairment tested for the year on this date. The recoverable amount was this much, and then for captive it was this much, right? So okay, so impairment test. Impairment test, right? So how will we do impairment test is basically, let's put the whole value of the company, so which will be goodwill at disposal goodwill, right? And then net assets at disposal or at the year end reporting date, right? Goodwill at reporting date. The reporting date. So how much was the goodwill earlier? It was this figure, right? And goodwill was this figure, and then net assets was this figure, because we are doing an impairment test at the year end only, right? So carrying amount of carrying amount of total net assets. This will basically be this figure plus this figure, and then our recoverable amount is this will be not C, it will be R, right? Amount is, how much is it for data? It's 1099. 1099. So impairment is there, right? Carrying amount is greater than, impairment is bolded, this minus this, right? So 50 was the impairment. So since this is a total goodwill method, so we can allocate it directly to this. So impairment will be there. So goodwill at reporting date will be this minus this 10, right? So impairment test for same thing. Since this amount, this impairment of 50 is for both, okay, because we are using total goodwill method, right? So this goodwill is already a total goodwill, so this will be accounted for NCI as well, right? Whereas in this case, what we need to do is that, so goodwill have to be calculated differently, okay? So parent and then NCI, okay? So parent's goodwill is, how much did we get? This figure, right? Whereas for NCI, it's this figure into how much was the parent's goodwill. So if 80% is equals to 120, then 20% will be 20 divided by 80 into the figure, right? So 20 divided by 80 into that figure. So our total goodwill will be this figure plus this figure. We are just making it comparable, okay? So from here, and then what about this reporting? That's 626. Oh, this figure needs to be changed. That's why it's so higher. 700. So see, like we are just making it comparable, right? So this impairment is minus 74, right? So what we need to do is that, okay, this is this plus this. Okay, so 76.25. So this is total impairment, right? So since we don't know the exact goodwill of NCI, so since we are only making it comparable right now, just to figure out what the impairment is, so what we need to do is that this figure into only this, okay, only parents, because this goodwill is only of parent, right? So impairment is only allocated for parent. No impairment is charged against NCI, okay? So our goodwill in this case will be 59.2, right? So our goodwill will be 59.2 plus this 10, right? So working note 3, we can write our goodwill. Our goodwill is this plus this, right? So once that's done, so what do we need next is PPE, right? Property, plant and equipment. So for this we need to also do something else, okay? Okay, so what do we need to do is that we need to add figure from working note number 2 and working note number 3. Okay, so which will basically be, let's put in the figures from here first of all. So 439, 810, 620, right? 439 plus 810 plus 620, right? Plus there has been few revaluation as well, right? Isn't it? In case of this is this figure, plus in case of there's another thing as well, in case of this is this figure, right? So and then after that what we need to account for is this land should be subtracted, but it will only be not 50, 64. I think this is the fair value of, this is fair value, right? So only carrying amount will be reduced from PPE, right? So it will be 56 only. Okay. Why did we do that? Because see what has happened is that debit cash. So what we normally did was, what we did was mm, so how much did we record in case of 64, right? That's how much total we recorded. And then that thing was not done. So all they did was debit cash. So this was the entry that they had done, right? Debit 64 and then credit SOPL. That's what they had done, right? So since this is already been added in SOPL, so that figure will flow down to retained earning, right? So what we need to do is that reduce it from retained earning, right? And then after that credit PPE, right? So how much PPE did we give them? We only gave them 56, right? So 56, and then this figure would be this figure minus this figure. So 8, right? So the net effect on retained earning is PP, because see this 8 will eventually increase the retained earning, right? So since we had only debited it by 64, right? Otherwise what you can do in other entry is that debit retained earning, and then what you can do is basically 56 and then credit PPE 56. Okay, you could do the same thing as well. So 56, it will have same effect. Okay, this entry could be done. The net disposal, the gain on disposal is basically 8 million. That's what I was trying to show over here. Okay, so once that's done, what do we have over here? Investment in this. Okay, investment is not there, we don't need to worry about that. Financial asset, right? Financial asset, what do we do about financial asset? I don't think there is any adjustment for financial asset, so it's pretty easy. 108 plus 10 plus 20, 108 plus 10 plus 20, right? And then after that current assets, right? No PURP, nothing else. So Pretty easy as well. 1067, 781, 350. 1067, 1067 plus 781 plus 350, right? 781 or 350? 381. 781, okay. Good. So what will be our total assets? Total assets will be bolded sum of all this, right? Sum of all this. So what about equity? So in equity section, share capital only for the parent. We will only put for the parent, right? 1120, 1120, and then retained earning will be from working note number 5, right? And then other component of equity, component of equity will be from working note 6. We need to segregate it, okay? And then next is we add this all up, and then next will be NCI, right, which will be working note number 4, right? We need to calculate that, and then non-current liabilities is also there, and then current liabilities is also there, right? So let's put in this figure first of all. 455, 323, 455, 455 plus 323 plus how much was the other one? 73, right? 73. So in case of current liabilities, it was 274, 199, 313. 274 plus 199 plus 373, right? 199, 313. So this will be sum of all this plus this, and then this will be our total equity and liabilities. Bold it, right? So this plus this figure of NCI plus this figure of total equity, right? So that's how much it should be, and then this figure will be basically this figure plus this figure plus this figure. So I'm just linking it up, okay? So what I'll do is next is let's do working note 4, okay? Working note 4. So since we have two companies, always remember calculation of net NCI, right? So since we have two companies, what do we need to do? We need to calculate for both of them, right? So this will be this, and then the next fair value of NCI will be this, because this is also NCI, right? Even though the holding percentage is only 20% in this, but still it will be considered as and this thing, right? So what about share of post acquisition profit? Post acquisition profit of data, right? And then same thing down below, but share of profit of captive. How much was the post acquisition profit? it was this figure, right? Into how much was the NCI. So NCI at the year end only changed, right? So okay, we will need to account for that as well. But for the time being, this is how much profit they are getting, right? And then in case of this fellow, it's 100 into 20%. So the NCI has not been purchased further, right? So what we need to do is that less. So what about impairment? First of all, let's account for that impairment. So only one, because in other we are using the other kind of impairment method, right? So 50 into how much will they be getting? So 50 into 40%, right? So 20 will be there. Impairment, this should be in minus into minus 1 again. So once that's done as well for NCI, and then what else do we need to do? How much was the impairment, by the way? Impairment was 50, right? Impairment was 50. What did I do? Into minus. How much was the NCI later on? 20% only, right? Yep. At the year end, it was only 20%. Why am I doing 40%? It was earlier. And then after that, in case of the NCI should decrease as well, right? So how much will it decrease by? Basically, is let's calculate that. Okay, less decrease in NCI. So what we will need to calculate is that increase in shareholding, which is a decrease for NCI anyway. So debit credit cash. How much did we give them? How much did we pay? 220 for extra thingy. 220, right? Yep. So 220 was given. How much net assets did we give them? So net assets, right? Or you can say debit decrease in NCI. Okay, so how much did we give them was basically, so what was the year end figure? How much was the net assets at acquisition? Acquisition was this plus so it was basically total companies. How much was it? No, what we will be doing is that basically how much was our net assets for data only. It's this figure plus this figure, right? So that's our total net assets for data only, right? As of the earlier at the year end, right? So impairment is not yet been computed because we purchased it on the last date, right? And then this was how much? This was how much holding percentage? It was 40, right? 40% is equals to this plus this, means how much will be 20% of that, right? So it will be 20 divided by 40. 20 divided by 40, right? So this is how much will be the decrease in NCI, right? And then what are we getting? So what was the net change? So we only paid this much. So what did we receive was extra, right? So that means this figure will be this figure minus this figure, which will be credit to other component of equity. Equity, okay, so this will basically increase other component of equity in parents holding, okay. So what was the net decrease in NCI? It was this figure minus this figure. That was the selling off, right? So total will be in bold sum of all this 343.5, which is K55, right? So let's link it up. K55. Now working note. Number 5, right? Bold it. Retain earning. So first of all, first thing first, 100% of parent. And then share of post acquisition profit of this two fellow. And then impairment as well. Alright, so what was the parent's retain earning? 1066, right? And then when calculating this figure, what we need to take into account is that share of post acquisition profit. So it's bracket this minus this, because other component of equity we need to separate it as well, right? So into how much was the parents holding? 80%, right? No, it was only 60% during this period. Okay, 85.8, right? So same thing over here as well. So I'll tell you why I am subtracting it, because I want to separate other component of equity, because we will be showing it in differently, right? Otherwise, if we add the whole, if we use the whole 100, what will happen is that we will have to present it same as well, right? So I don't want that thing to happen. So this figure, which is impairment into it is this figure, right, at the year end. So 40 will be allocated minus I7, okay. And then what about less? What did we debit before? Something over here. Return earning, yep, for this. All right, 56 should be subtracted minus 56, right? This is not impairment, it's about sale of NCA, right? Which is from working note 3. So once all this thing is done, let's sum it up. Okay, what about the impairment of the other fellow? Impairment of data less impairment of captive, right? So there is an impairment for that as well. Minus how much is it? So we don't need to, this is already for only parent, right? Why am I writing total goodwill over here? Parents goodwill. Parents goodwill, okay. So once this is also done, so this will be our total, right? Of the test K65, right? Retained earning is K65. Okay, so next thing is working note number 6. So what has happened with OCE is that let's not forget component of equity. So there has been a positive movement in the component of equity as well, right? So first will be 100%, and then after that data, after that captive, and then next will be positive, which is basically from purchase of additional shares, right? So what has this given us? Let's not forget it, this figure, okay? There has been a positive because we only paid 220, but how much did we receive? In case of net assets, we received 228, so there will be a gain for us, right? So 8.3 is a gain. That's why I don't want to miss that figure. That's why I'm writing it down, okay? So 100% of traveler, right? So what was the parents other component of equity? 60, right? 100% of parent. And in case of data, how much is the net changes in other component of equity? In case of data, the net changes is 11 into our holding percentage, right? 6.6. So in case of captive as well, it is this figure. Remember, I had already removed it from retained earning when calculating it. Otherwise, if I had just used the whole 80 or the 100, it would have given us. So I'll show it to you. It'll be more easier. Okay, so see, and this captive plus if I add this captive, how much I'm getting? 80, right? So how much did we get over here? It was 100, right? So if you multiply this by your holding percentage, you'll still be getting 18, right? So what I did was I just broke down this 80. Okay, so what I basically did was I had just broken it down. So what I did was basically I separated the retained earning component without the other component of equity, so that it will be easier for us to present it. Okay, that's why we did it. everything, right? Sum of all this. Bold it. Okay. That's right. So this is J73. So let's see how our balance sheet is doing. J73 4250 4250. Good. Okay, so once our SOFP is prepared, let's move on to next thing. What are we required? In the next is management of traveler on the points raised above. Distinct business segments, the management has calculated the net assets turnover profit before common tax which are allocated to these segments. However, they are unsure as whether they should allocate certain common cost, whether they can exercise judgment in the allocation process. They wish to allocate head office expenses, pension expenses, and the cost of managing properties and related interest. Okay, so they want to do that. So they're asking whether they can use their judgment or not, right? So what we will do is that let's do it in next part. So I don't want to make this video so long. So if you've got any questions until now, please do comment down below. I'll definitely answer it for you. Until next time, I'll see you in next question anyway.